Okay, we'll start off the webinar. Thank you for everyone who joined us. Delayed because of an incident of COVID last week and a few IT delays as we get started, which always makes these things more interesting. But we're ready to get started. So today's webinar is about moving to Portugal under the Non-Habitual Residency Scheme. A very brief hello from us is Matt Penfold and Paul Correa from Fiduciary Wealth. Some of you may have spoke to us before. We won't give you the long intro, but feel free to look up on our website. And as we're talking about webinars, we've run plenty of these and they're all hosted on our YouTube channel. So we would ask and urge you to subscribe to our YouTube channel, Fiduciary Wealth, and like and share with friends, colleagues, people you know that may be interested in some of the content that we're putting out. So as I say, today's webinar is about moving to Portugal under the Non-Habitual Residency Scheme. We will be answering any questions that you have at the end. There's a question and answer function on the Zoom, so feel free to submit your questions as we go through the webinar, and we will get to those at the end. So we're just running through briefly what we're going to cover. So we're going to cover the UK exit and your UK domicile, which is very important, and we'll explain why. The visa types, the tax benefits of NHR, some tax planning opportunities and succession planning opportunities. Then we go on, we'll talk about the issue of capital gain. Some of you may know it's not covered by the NHR, and we'll explain what the options you have there. A little on UK pension transfers, which we're always asked about, and the timing of selling your main UK residence. And we've got a few frequently asked questions at the end, a final bit of advice, and then we get to your Q&As. So wonderful. So we get started. So Paul, I do the intro, but I'll pass to you for the content everyone's waiting for. So if you can just talk about, and we'll start from the start, and something that maybe people overlook, planning your UK exit and how the UK statutory test feeds into that.
Yeah, thank you, Matt. Welcome everyone. I'll cover it as briefly as I possibly can. Essentially, you need to be aware of the factors which determine whether you are considered a UK tax resident in a particular tax year. Clearly, the number of days that you physically spend in the UK is an important consideration, but it's not the only one. You also need to think about the pattern of your presence in the UK, your links with the UK in terms of family, social connections, owning property, working life, etc. It is the UK Statutory Residency Test 2013 which determines and allows you to plan the date in which you become non-UK tax resident, and essentially it also determines how much time you can spend in the UK without re-triggering, I should say, UK tax residency. And essentially it looks at your ties and connections with the UK, and that will determine how many days you can trip back to the UK every year. No point in exiting the UK if you are planning to stay lengthy periods of time in the UK and be deemed tax resident. So whilst you may have a non-habitual residency certificate in Portugal, if you're exceeding the number of days you're allowed to spend in the UK, well, you know, guess what? You know, HMRC are going to challenge you. The other thing to consider when you're exiting the UK is ideally that you should do it cleanly at the end of the UK tax year, which is on the 5th of April. Now, we have to accept that the tax years are not running, they run on different time periods. So in the UK, it's from April to April, and in Portugal, it's on a calendar year basis. But always, when you exit the UK, always advisable to do so because it's cleaner at the end of the UK tax year on the 5th of April. There are specific situations where split year rules apply automatically, and they're not questioned or challenged by HMRC. And the three instances where you can have a split year, not necessarily on the 5th of April, without having concerns about being challenged by HMRC, is if you start full-time employment overseas, if your spouse or lifelong partner is starting full-time employment overseas, or if you cease to have a UK home. So there are caveats to the earlier statement that it's always preferable to go for a clean break at the end of the UK tax year. Yeah, but it's there's, as I keep saying, little point in moving to Portugal without with its benign tax environment, without having first planned your UK exit strategy. Always advisable to seek tax advice from a relocation expert who understands the interaction between the UK and Portuguese tax regimes and can help optimize your tax position. And then lastly, Matt, never forget to advise HMRC of your departure date and completing Form P85, which, surprisingly enough, many people forget about. And that's, you can get the P85 if you go to www.hmrc.gov.uk.
Perfect. Thank you, Paul. And while we're talking about the UK side, a lot of people that I think that we both speak to don't consider their UK domicile. They don't quite understand that and how it affects them when they exit the UK and the effect on UK IHT, inheritance tax. Can you explain why that's so important?
Sure. It has to be very brief because it's a complex area. And if we went into the detail, I mean, this webinar would take far too long. But let's try and keep it short and explain succinctly why this is so important. Well, firstly, let me start by saying the good news is that there's no IHT in Portugal for direct descendants and ascendants. Now, the bad news is you're likely to remain UK exposed. You remain exposed to UK inheritance tax by virtue of the fact that you are probably born in the UK and so is your father, in which case the concept of domicile of origin kicks in. And this is something you acquire at birth, as I said, taken from your father. Whilst you can claim an acquired domicile of choice by settling in a country with the intention of living there permanently, it is not straightforward. It's often fraught with difficulty. There's no fixed rules. The burden of proof falls on you to prove that you have successfully acquired a new domicile of choice. And remember, it often happens once you passed away. Yeah, HMRC will challenge the heirs to your estate in terms of whether you successfully acquired a domicile of choice. But in any event, assuming that you did everything by the book, not that there's any rules or a book of rules, but let's assuming you were successful, which again we would question because very often you get challenged. But it's not uncommon for Brits to return back to UK either temporarily due to ill health or perhaps more permanently if one of the spouses passes away. And even if you return to the UK, Matt, for 1 year on a temporary basis, that's enough to retrigger your UK domicile of origin. So theoretically, you avoid UK IHT after 5 years of non-UK tax residency. In practice, it's much more complicated. Again, we go back to the statutory residency test. Your business interests, your social and family connections, property ownership, or even something as innocuous as intentions can result in you being considered domicile for UK inheritance tax purposes. I mean, we've known that even insignificant ties can be challenged, and HMRC are known to rely on the most tenuous of grounds to dismiss claims that the domicile of choice has been acquired. If we look pre-pandemic and post-pandemic, the Office of Budget Responsibility has said that, UK IHT was pre-COVID, tax receipts from UK inheritance tax was like 6.1 pre-COVID. It's going to be 6.7 this year billion, and they expect it to go to 8.3, 8.4. So did I say billion? Is it billion? Yeah, I think it is billion, and they expect it to be something like 8.3, 8.4 by 2026. I think it is. So yeah, they're collecting more, and if you look at the average case size by estate, it's gone up from 206,000, and they expect it to hit 266,000 by this year. So yeah, I mean, HMRC need to collect. The UK is have got a lot of debt, and they're running budget deficits, and they have to collect more tax revenue. So UK inheritance tax, which is really a voluntary tax, is a perfect way of raising revenue. So yeah, I think important to think about that. Look, the most high-profile case is that of the Welsh actor Richard Burton. He lived in the US for many years, moved to Switzerland in 1957, spent 27 years in Switzerland, passed away in 94, had professional advice of the highest quality, severed all his links with the UK for more than 30 years. HMRC came back and successfully claimed on his estate on the grounds that he never relinquished his UK domicile, notwithstanding the fact he had been away for 30 years. And the claim was successful, Matt, because he purchased a burial plot in Wales. So they claim his intentions were to return, and he retained emotional ties with the mother country. And the fact that he was buried in the red suit, in the Welsh dragon colours, and holding a copy of Dylan Thomas' poems, apparently was additional grounds for successfully claiming on his worldwide estate. So an estate of £5 million ended up paying a UK IHT of 2.4 million, which in those days, in 1984, was an awful amount of money for someone who had done everything properly. So you can't really rely on a domicile of choice. You just don't know until you passed away. And of course, you don't want to pass your legacy to HMRC when inheritance tax is a voluntary tax.
Perfect. Thank you, Paul. That's a really good summary. So we'll move on to part two. So which we'll touch on briefly on visa types. I think I'll repeat what you said, Paul. We're trying to cover a lot of areas in this webinar, and if we cover them in too much detail, we'll be here all day, and people will be bored with us. So we're trying to touch on the key points. And for those of you interested who think they may want to use our services, you're more than welcome to kind of contact us for a consultation. So the visas briefly, and we talk about the visas because sometimes people misunderstood that non-habitual residency, the NHR scheme, is a right to residency. It isn't. And people are often confused by the name non-habitual residency and think they don't need to live in Portugal. That's not true. The non-habitual refers to the fact that you haven't been a tax resident in Portugal in the previous 5 years, but you do need to be a resident to gain those benefits. And like Paul says, there's no point in gaining an NHR certificate and then you trigger UK tax residency, or you don't spend enough days in Portugal. So post-Brexit, and we're in a post-Brexit world now, if you're an EU national, you hold an EU passport, then you don't need any visas. If you're a UK national, then you will need a visa. And previously, when we've done these webinars, we've talked about the two main visas, which were the golden visa and the D7 visa. Now, a lot of you may have seen that the golden visa route has now controversially been closed down by the government as part of their attempts to control what they deem a kind of housing supply issue in Portugal. Paul, I think you covered this very well in a podcast we did once, and in the sense that they could have just changed the golden visa and still run with that in a different format, but they haven't done that, and so those who have previously applied for the golden visa stay in the scheme, but it is closed to new applicants. So if you need a visa, we're really looking at the D7 visa, which is also known as a passive income visa, the Digital Nomad visa, which is relatively new. The D7 visa, as the kind of nickname suggests, is for those who have passive income to show that they can be self-sufficient in Portugal. So you have pension income, investment income, maybe rental income from the UK, dividends, things like that. Previously, they have accepted people who have maybe been able to work remotely, but now they have the new Digital Nomad visa, then they would expect people to apply for that. For the D7 visa, the requirements are fairly basic. You need to prove that you've got that income to sustain yourself, which is just under €8,000 a year for an individual, or around 11,500 euros for a couple. You need to prove that you've got a clean criminal record, comprehensive health insurance, accommodation in Portugal. Before you apply, you need to obtain your Portugal NIF, which is effectively your tax number, and open a Portuguese bank account. Those are things that you can do remotely. The other alternative is the Digital Nomad. It's actually a very similar process, and you still need those, the NIF, the bank account, the clean criminal record. But the requirements on the income are higher for the Digital Nomad. It's around €2,800 per month that you need to demonstrate. There is also the D27 visa, which is for entrepreneurs who want to establish a business in Portugal. But it's quite complicated. You need to submit a business plan, show you've got the resources. And so we won't go into the detail for that. And the other option is you gain a visa by being employed by a Portuguese company, but they need to demonstrate that there are not enough candidates within the EU to fill that vacancy, which again is unlikely. So we move on to the benefits of NHR, and again, for you to have the benefits of NHR, you need to be residing in Portugal. So to be a tax resident in Portugal, the most simple assessment of that is you have to spend a minimum of 183 days in Portugal during that tax year, which happens to be the calendar year in Portugal, which makes it nice and easy. And the NHR lasts for 10 years. So that's 10 years from the start. You can exit Portugal for a few years and return, but those years when you exit, you don't gain those back. So an example, you spend 4 years in Portugal, then you spend 3 years elsewhere, then you return, you've just got the 3 years left. And we may kind of touch on why somebody might do that a little bit later. So the tax benefits in brief. So employment income is taxed at a flat rate of 20%. That's if it's deemed a high value activity. There's a list which we can supply to people, which shows what qualifies as that. Foreign sourced income is exempt as long as it's deemed taxable in the country where it's generated. So UK rental income, for example, real estate capital gains, they're taxed in the UK's example, they're taxed in the UK, so you don't have to pay the tax in Portugal. And it's important to add, we based the webinar on people relocating from the UK, and NHR is based on the double taxation agreement between Portugal and the country that you're arriving from, or the income is derived from. Now, the receipt of dividend income is a huge draw under NHR for those coming from the UK. And this is because of the detail in the double taxation agreement with the UK. And effectively, it's deemed under the Portugal side, it's deemed taxable in the country of origin, so the UK. In the UK, it's deemed taxable where you're tax resident. So if this is structured correctly, it is possible to receive those dividends from a UK company completely free of tax. Another benefit is pension income, which is taxed at a flat rate of 10%, but this can be structured to be even lower, which we'll cover briefly later. And the final thing that we always add is capital gains tax, and capital gains tax is relatively high in Portugal at 28%, and there's no exemption under NHR for that, which may be something they missed out. Maybe it was on purpose. We're not sure on that one. But so for the purpose of capital gains tax, you need to make sure that you plan properly, which we will get to later. The final one, this isn't really related to NHR, it's Portugal in general, and Paul, you covered this earlier, sorry. There's no succession tax to direct descendants or ascendants in Portugal. But of course, I repeat what Paul said earlier, you really need to be wary of UK inheritance tax. So we move on to kind of tax planning opportunities. And there's a few options to consider. We'll cover them again briefly here. Maybe not everything, but maybe the kind of main options that you have. And I will tie this in with the succession planning opportunities as well. So you do have the option of transferring your UK pension to a qualifying recognised overseas pension scheme, or commonly known as a QOPS, which is held offshore. Now, there's quite a few benefits to that. The death benefits are more generous. Well, it's interesting actually. One of the draws for this was if you transfer your pension to an offshore pension, then that pension is tested for the lifetime allowance, which a lot of you will know has recently been removed by the UK government. So previous advice was to transfer your pension where it's still under the limit, which was just over 1 million, and the pension can continue to grow over and above that limit, and there'll be no further tax assessment. Now, at the moment, there's no lifetime allowance, but a lot of the noise coming out is if the Labour government get in, which is quite likely if you trust the polls, then they will want to reinstate the lifetime allowance on pensions. So again, if you're looking to move to Portugal or you're already in Portugal, of course, it's difficult to plan with what may happen based on, what the politicians to decide, but you may want to consider taking advantage of this window where there's no lifetime allowance limit. You can transfer your pension offshore, and depending on how, if the limit comes back in and the guidelines around that may be a very kind of sensible move for you. With your UK pensions, you can always transfer them to an international SIP as well. That allows the income to be paid out in euros. There's a wide range of investment options. You still have flexible access to your pension. So how you deal with your UK pensions, there's no one size fits all for everyone. You should talk to a professional such as Paul and I, and we can give you advice and guide you on that process and assess what are the best options for you. We talk about kind of tax planning and capital gains, and there's a couple of options which you can take advantage of here. One is a QNUPS, which is a qualifying non-UK pension scheme, which is sometimes referred to as the sister product of a QOPS. So whereas a QOPS is funded through a transfer of your UK pension, a QNUPS is funded via a lump sum investment. So you may have had an investment portfolio in the UK, ISAs, maybe UK property that you've sold. You want to find a home for that. So the QNUPS is a pension scheme that you can fund for a lump sum. Now, once that money is in with the QNUPS, there is no capital gains within that. So it can grow in value, no capital gains. The main thing for the QNUPS is it needs to be set up as a genuine retirement vehicle. If that's done, and what we mean by genuine retirement vehicle is the funding is in line with your wealth, age, income requirements, then if that's set up properly, then the funds in the QNOPs are immediately outside of your estate for UK inheritance tax. And that applies even if you return to the UK later on in life. So there's a very kind of nice benefit with that. And the QNOPs, the income can be structured in such a way that only a proportion under Portuguese tax law of this is taxed. So it can be structured using what they call a temporary annuity. And this is possible with a QROPS as well, if structured correctly. And only 15% of the income is taxed. Based on the 10% tax rate under NHR, that's an effective tax rate of just 1.5%. Now, the other option that some of you may have come across is the Portuguese compliant bond. And I'm just going to try and, if I can share my screen here with just a little bit of information on this. So let's see. Maybe not. I'm showing our IT skills again here, Paul.
Don't ask me for help.
Okay, let's see. Okay, hopefully people can see that. So the Portuguese compliant bond. So again, invested via a lump sum. It is possible to add investments to that. And it benefits from tax deferral. So your investment continues to grow. There's no capital gains tax on that unless you make a withdrawal. And when you make a withdrawal, the tax rate that you pay reduces down the longer you hold the investment for. So hopefully those watching can see that table there. So in the first years, it's still 28%. Then between year 5 and year 8, it's reduced down to 22.4%. See that on the right-hand side. And then year 8 onwards, it's down to 11.2%. And bear in mind, and I'll swap the slide over, that is based on the growth element of any income withdrawals you make. So you invest in the Portuguese bond, it grows in value. You then decide you want to take an income payment from it. The bond provider can assess what is return of capital and what is growth based on how the investment's grown over time. And then only the growth element, the taxation is applied to that. And the rate depends on how long you've held the bond for. So the longer, better. So using that example, a very simple one, a modest investment of 100,000 euros grows by 50%. So it's now 150K. The individual here wants to make a withdrawal of 15,000. So it calculates the gain element of that is 5,000 euros. They've held the bond for 8 years or more. So only 11.2% rather than the 28% that would be paid if it was held outside of the bond. And the tax is withheld there by the bond provider. They pay it directly to the tax authorities and you receive the rest. So we see an effective tax rate of 3.73 using that example. So I will stop sharing that so everyone can see me again. I'm sure they were missing our faces there, Paul. And another reason why somebody may use the bond or the QNOPs actually, and people don't consider this because in the UK, we sell our main property, our main residence, and there's no capital gains. In Portugal, there is. So even if it's your main property and there's a gain on there, you're liable to capital gains on 50% of the gain. Now, this is if you were to sell your property and keep the cash, maybe you want to rent, or you sell your property and you're going to downsize, is based on the gain. If you sell your property and then reinvest that money in a property of the same value or higher, then there's no capital gains. But if you were to downsize or you want to sell and rent, like people may do in kind of later life, if you was to reinvest those proceeds in a qualifying investment in Portugal, which the Portuguese investment bond and the QNOPs both qualify, then there would be no capital gains on that growth element. So it kind of solves two problems really. You sell the property and you either downsize or you liquidate. You need to find a home for that money, but also you're concerned about the taxation because the value of your property in Portugal has grown. Then you could use the Portuguese investment bond or the QNOPs to help you out on that. So Paul, I think I've been speaking too long, so I'll pass back to you and just the last note on capital gains tax. Again, we say it's high in Portugal, 28%. What about for those who maybe have business interests in the UK? They want to sell that business. Are there any options for them?
Well, I mean, one possibility would be to interrupt the non-habitual residency for a year, which they're allowed to do. It may need 2 years, meaning one tax year, and perhaps because the tax years are not running over the same period in another jurisdiction, it might require 2 years of non-habitual or every case is different. But one possibility would be to interrupt non-habitual residency, move to Gibraltar for that year, dispose of your shares in your UK business and not be subject to capital gains tax in Gibraltar. Remain UK Gibraltar tax resident for, as I said, for that year, and possibly 2. You can still trip to Portugal so long as you spend less than 183 days, and eventually resurface in Portugal and resume your non-habitual residency. Look, you forfeit a year of 2 of non-habitual, but on the other hand, Gibraltar is just as tax efficient, if not more, and you avoid capital gains tax. Look, if it's a very small amount, if you're disposing of your business interest and they're going to pay you 100,000, and you're subject to capital gains at 28%, that's 28,000. You might say, is it worth the trouble? If you're disposing of your UK business interest and the disposal value of the shares in your business is, for argument's sake, 1.5 million. Well, 1.5 million at 28% is almost, what is it, 400,000? Then you might, the inconvenience of establishing tax residency in a third country, which is not the UK either, for a year might be worth it, And if I've had cases of 10 million. I have a recent one involving US, Ireland, and Spain, 10 million. And the saving is then a considerable amount of money. I think in the US it was 25%, so it's 2.5 million euros. Then of course moving to Gibraltar makes perfect sense. Each case is different, but yes, there's ways of circumventing Portuguese capital gains tax, so long as you are, flexible, nimble, and you're prepared to, move around to achieve your tax optimization.
Perfect. Thank you, Paul. And while we're talking about the UK and disposing of assets, what about those who are relocating and they have their UK main resident? Should we is there guidance around the timing of when they should sell that?
Well, I mean, it's not uncommon for a Brit to sell their main UK residence to fund the acquisition of a property in the new country of residence, be that Portugal or any other country for that matter. Of course, it would be advantageous to do that whilst capital gains tax exemptions remain in place. If you sell your UK property before leaving the UK, then needless to say, you're still eligible to principal private residence relief, so no tax to be paid. If you sell, however, your main residence after you've left the UK, but within 9 months of doing so you leave on the 5th of April 2023 and you want to sell it on the 5th of December 2023, within 8 months, then those capital gains exemptions, notwithstanding the fact that you're no longer tax resident, they tend to stick. But after 9 months, they start getting diluted. So clearly, it would be advantageous if the intention is never to retain a UK residence, or maybe you want to downsize your property, yeah? Effectively release some equity, a lot of equity from a main residence, which may have an inflated value, buy a bolt hold in the UK for when you go there, because you've got family and so on. But dispose of that main residence and take full advantage of those capital gains of the private residence relief within the 9 months. So it's not just about, you know, getting on that flight and moving to Portugal. It's about thinking and planning all those things, because, you know, all the tax savings add up over time if you're smart. And you know, and people try to do it on their own, and then they end up, you know, paying the consequences of not doing it properly in the right order. And look, I can go into the 3 methods for calculating capital gains, but I think this is outside the scope of this webinar to go into minutiae. But that is the essence of how an individual can take full advantage and avoid CGT on sale of the main property.
Perfect. Yeah. Thank you, Paul. And I think the key point from what you said for me there was the planning. There's so many moving parts, so many different things to consider, and you know, we speak to many people, and of course there's excitement about starting your new life in Portugal, but the sooner you start planning, the better, because we both had scenarios where we speak to people, they say, okay, I'm in Portugal now, I'm a tax resident, what do I do? And there may be things that they've missed, and it's too late to go back. So the sooner the better, I think is wise words. Just to kind of last on this part for us, the treatment of UK pensions and taxation of pension income. So we touched on the pension income, pension options, the QROPs, the international SIP. Again, they should be assessed on an individual basis. Regarding the UK pension transfers, and again, we'll cover this briefly, but in the last few years, we've seen well, there's often many changes in the pension industry, and especially last year, they introduced what they call the traffic light system. This is regarding UK pension transfers. That's either internal ones or transferring them offshore. And this traffic light system is effectively saying, red, you can't transfer, amber, you need to go through a process, or green, we can go forward with it. And we're seeing lots more scrutiny on this. There's higher powers given to UK pension schemes who may not want to do the transfer to lose business or for whatever reason. So I think really the kind of point on is there is still opportunities for those people to transfer their pension out of the UK, and there's many reasons why they would want to do that, but that window may be closing. So it's another situation where we would say, look, you need to kind of act, look into this as soon as possible, evaluate your options before that window closes. So Paul, we're getting to the end. We've got a couple of brief kind of frequently asked questions
Okay.
for me, if you don't mind.
Yeah. My first question would be, because it's one that is frequently asked, once the non-habitual residency regime comes to an end after year 10, what happens next?
Okay, yeah, so I guess to add from earlier, the NHR is just a tax scheme. It's not your residency. So as long as you have your residency in place, either your visa, or you might have permanent residency by then, or you may even be working towards citizenship, you can continue to live in Portugal. The tax changes, the tax benefits end. You effectively pay tax in Portugal a normal tax rate. So they have income tax rates that are banded like the UK, and that apply to kind of pension income, employment income, things like kind of rental income. You would need to now kind of declare and potentially pay tax on this in Portugal. So again, it's part of the planning, and you know, if your intention is to live in Portugal for the rest of your life, then you should plan at the outset to take that into account. We talk about the Portuguese investment bond and how the tax rate reduces down after year 8. So a lot of people like to establish that way in NHR, and then they know it works favorably for them within NHR and post. So yeah, you can stay in Portugal, but you just have to pay a bit more tax is I guess a short answer.
Okay, and I have one further question, Matt, if I may.
Of course, yeah.
What happens if I move to Portugal and under the non-habitual regime, and then for whatever reason you have to return permanently to the UK?
Okay, I mean, we see this probably more often than people would expect. People will return to the UK. I know we both had clients, Paul, who've done that for whatever reason. They want to spend more time with maybe the grandkids, or there's a loss of spouse, or health complications. In reality, it's a relocation in the opposite direction. So I think it's important to have an established relationship with someone who can provide you advice in that situation. Um, and you just need to ensure that things are structured well for your return to the UK. There are tax planning opportunities when you're relocating to Portugal, there are tax planning opportunities when you're returning to the UK, and it would be wise to take advantage of those. So again, it's worth talking to a professional who understands both sides, and they can guide you through the process. Perfect. So Paul, just to finish off, and I'll ask you one question in return. If you was to give one piece of advice to someone looking to move to Portugal under NHR, what would that be?
Well, the advice would be to don't try to be too smart if you don't understand all the nuances and interaction between the Portuguese and the UK system. Very often I see individuals planning to move and Googling information and thinking they can piece it all together. Very often they rely on friends and friend of friends to try again, piece it everything together, and they end up with a problem that then needs to be unraveled. It's a bumpy road, and you really need a trusted advisor by your hand who has a personal interest in ensuring that this is done properly and it's well thought out and it provides certainty. I think that's key, certainty, that it's a smooth and seamless transition to your new country of residence, that there's no nasty surprises further down the line, that everything has been done properly and every conceivable angle has been considered to optimize your tax position. And failing to plan is planning to fail. You need a timeline, you need a strategy, and you need an advisor that can help you execute that strategy. There's a lot of steps that can be missed or taken in the wrong order, and that leads to the wrong outcome. So yeah, it's important. Then I would say I go back to the issue of sorry, I keep harping on about inheritance tax, but when it comes to UK inheritance tax, very often, because people, it's a morbid subject, people don't want to talk about it, and they postpone and they postpone and they postpone again because no one wants to talk about something about death, right? So it's always advisable to address the issue early and not when you're on your deathbed. It's always advisable to plan for the worst and assume you're going to be liable to UKIHT and then hope for the best, because a negative posthumous determination by HMRC would deprive your loved ones from the inheritance or the legacy that they are entitled to. And it's a voluntary tax. It's not, it can be avoided or significantly mitigated if done properly. So sorry, I go back full circle, but I think it's something that is missed time and time and time again. And it's criminal that people are having to pay, on average in the UK, almost £300,000 in inheritance tax when frankly it could be zero.
No, absolutely. Perfect. Thank you, Paul. And I think that finishes us off nicely. So we just get to the end and the question and answers, and we do have a couple of questions there. So firstly from Gareth, My wife is an Irish passport holder while I'm a UK passport holder. Does this have any impact when we move to Portugal? And I think it does, Gareth. Yeah. So your wife as an Irish passport holder, she has a automatic right to live and work where she wishes in the EU, and you as her spouse are able to benefit from that. So the process for residency in Portugal will be slightly different. You can skip a few steps. You don't need to go through the visa. You secure your residency directly with Portugal. But yes, it makes it a lot easier for you. It does. And then a second question, Paul, if you want to.
Yeah.
So my wife and I have UK NHS pensions. I think that I read that government pensions are taxable in Portugal. Have I misread? If not, what is the impact of having something classified as a government pension? I think on that one, Gareth, I think it's less about Portugal and it's more about the UK. Generally, pensions are taxed where you're resident. So in Portugal, and that applies to most UK pensions, but there are some UK government pensions. I presume because of the contributions that have come to the scheme throughout your working life, where you have to continue to pay tax in the UK. So if you pay tax in the UK and you're under the NHR, then you pay, and that's what the scheme dictates, then you would pay tax in the UK, and then under the NHR, you wouldn't pay tax in Portugal because of the double taxation agreement. I think I've got that one right, Paul?
Yeah.
Good. Wonderful. Okay, so we've reached the end of the webinar. So thank you for either those who are joining us live today or those who are watching this on our YouTube channel. Once again, we would say, there's a lot of free content going on our YouTube channel on different subjects, more related to Portugal. So subscribe, like, share on there. And if you're serious about moving and you think you want to partner with a serious firm who can guide you through the process, then reach out to us, inquiries at fwm.gi, visit our website, YouTube. You can review our reviews on Trustpilot, and yeah, hopefully there's a few of you that we'll speak to in the future. Wonderful. Okay, thank you, everybody.
Thank you.
Bye. Bye.
Bye.